Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. Today we had no change on the larger time frame. However, on the daily, we see a market that seems to have entering short-term balance. Gains post FOMC, which was last Wednesday, have been reversed very sharply today. Provided the toned down dovishness that the Fed officials gave in their respective speeches. The next reference to the downside, the limit in the range, is now the FOMC day low and the gap that held last Tuesday after positive news on the trade front. On the market profile, the important thing to mention is, and we did mention this in the briefing that we put out this morning, that with a no short overnight inventory, failure to rally would expose market weakness. And you can see how after the open, with just one tick to the upside, we started pushing down. Now, what I mentioned as well yesterday was that it was possible that you had a long buying into this area, the 29.48, judging by the excesses that we've seen on Friday, last overnight session, and yesterday's session. So we had a lot of long inventory accumulation there, and with a weak market and sellers stepping in, those buyers were forced to liquidate their positions, and that explains why the sharp move to the downside. However, we revisited the prominent overnight POC. We kept going. We took the overnight low. At that point, it was pretty clear that the selling was strong. The other important thing is that after the tempo slowed down a little bit to the downside, it could be seen how the short-term traders rely on market sentiment to sell every rally and effectively taking the price down. The reason I say that is you can see that there was a lot of mechanical selling. For example, the D high coming one tick above the overnight low, then the F rally, the F high came one tick short, then the G high selling from exactly half back from the F period, and then later it continued, and you can see after some responsive buying and some pullbacks, the K high, the L high came to one tick above the K, and so on. So you see that it was short-term traders driving the market. However, the overall sentiment was down, and you have also momentum traders stepping into the downside, and effectively they took the market down for a very large move. But you can see how elongated the profile is, and it's not very uniform. You have a bunch of distributions along the way. Having said that, this data point brings me a little bit of cautiousness to the table, because if you remember correctly, yesterday's session, we started selling from the third period, all day long, selling, very mechanical selling, the same short-term traders, the things that they didn't have the sentiment and the momentum yesterday, and they didn't achieve it. But all of this was selling. Then the overnight, most of it was selling. So that's why you had the overnight short inventory. And today, the whole day was selling and from mechanical reference. Therefore, this opens the possibility of the market getting extremely short and in hands of short-term money. And that's a very dangerous situation, because you can revert very sharply. So given the extent of the move, the immediate focus is on assessing continuation or lack of it, with acceptance above the afternoon high at 29.50, denoting change and increasing the odds of a repairing rotation back up. On the other hand, if we get acceptance below, that increases the odds for continuation, potentially bringing into play the reference low, which is the FOMC low, and the gap that we have down there.